Welcome to our weekly investment update for Friday the 12th of June. My name is Chris Marshall. I'm Head of Investment Strategy here at Dragon Investment Managers. Now, as we look around the world this week, it's a very different mood and tone and sentiment to the one that we were discussing last week. Last week, of course, we saw equity markets put on around 6%. Depending on which equity indice you were looking at. This week, most of those gains have been erased with some really heavy selling days, and in fact yesterday was the largest down day we've seen since back in the rapid sell-off of March this year. So what's going on? What's causing this? Well, the media, if you want to give the attention to them, they would say that this is all about second wave fears. But that's not strictly true. In fact, if you simply just go and do a Google search, you will find that second wave fears have been talked about for a good number of weeks and even months, because this has been something that the epidemiologists and virologists have been saying that when the economies reopen and people start coming back out, then of course there is this chance of a second wave. So it doesn't seem that that is new information or information which markets are really needing to reprice in because it's already in there. And this is much more to do with really the two central stories we were talking about last week, and that is how investors have really been pinning a lot of their hopes on central bank and fiscal policy action. And of course the difference this week was we saw the cheerleader for monetary policy come out, Jerome Powell, the US Fed chair, and really say that his view was that the economy would be very, very slow to recover. They would keep policy rates right down as long as possible, or even as long as needed. But in his view, that this was going to be a long, slow recovery with low rates talked about until 2022. And this has really changed the tone. Of course, up until this point, most of the rhetoric around monetary and fiscal policy was that they could bend gravity and that they could keep this state of levitation within markets while the real economy covered underneath. What we're seeing in the real economy, this bifurcation that we've been talking about for the past few weeks, is really now starting to come through, and people are starting to kind of question, well, will we see this V-shaped recovery that has been so overly flaunted by so many analysts? And for us, we've always kind of kept a little bit of a cautionary stance. We've managed to keep ahead of benchmarks by some superior asset allocation and also asset selection. But we have kept one foot kind of very much on the cash balances of our portfolios, which protect us on these down movements and also allows us to participate as opportunities open up. So as we look around the world today, of course, some of those issues coming to the fore. We have severe geopolitical tensions ongoing between US and China. We see social unrest everywhere from Hong Kong to more westernized regions which are protesting and rioting. And then, of course, we come down to the fiscal policy measures, which we're starting to see governments starting to tire a little bit, unwilling to really do very, very aggressive fiscal policy simply because it becomes politically unpalatable. This is particularly true in the US, which of course is now really going into election season. And so a lot more weight is going to be given back to the central banks just to see what they can do. The risk, however, is of course that central banks are very, very good at taking out liquidity risk. And this is why, as we said in a previous weekly market update, that the market rebounded so rapidly from March because one of those risks was taken out, and that was the liquidity risk. But then, of course, based on top of that, people thought, well, okay, all risks have gone and the worst is now behind us. But as the data showed us this morning for GDP in the UK, we saw within April a minus 20% contraction in GDP, which is a phenomenal figure. And add on top of this some announcements yesterday about an awful lot of job losses in the UK. We saw Lufthansa coming out saying that they might be cutting 22,000 jobs. We've seen job cuts in the US as well. And although we are seeing a downward trend coming back to the US job numbers, although we're seeing a downward trend in the initial jobless claims, we're still at 3 times the rate that we would expect it after a recession. So there is a lot to still work through. For us, I think still there are some green shoots out there, and those green shoots really remain pinned to the reopening of economies, which is still going on. Yes, there is some talk about this second wave fear, and certain towns and counties may shut down, but I don't think we'll see the national lockdowns as we did last time round. And so there'll be a disruption in certain areas, and perhaps companies with really long supply chains will be more affected than those which have very short supply chains. There seems to still be an uptick in mobility, which we can see coming through from data providers such as Apple and Google, who track cellular data, and also the prices at fuel pumps is signalling that people are out moving, driving, and the economy is starting to come back on track. The real economy data, as dire as it is, may also spur on governments to speed up the reopening phase. This is really one of the things that I think Mnuchin was saying in the States this week, was that if there is an increase in infections, simply the states cannot afford to keep supporting the economy as they have. Take the UK, for example. There are 11 million furloughed workers on the scheme at the moment, and really that needs to be shifted back on to the corporations, and to do that, of course, the corporations need to actually be allowed to open. So I think there are still some green shoots. There are, of course, all these issues that we've been talking about for the past few weeks, and why we've maintained a fairly cautious stance with some fairly high cash balances, far higher than we normally would in a trading environment. And I think we're fairly well positioned both to dampen the sell-offs as well as pick up opportunities as they arise. So that's a quick summary of what's going on. I wish you a very healthy and happy weekend, and from myself and all my colleagues at Dragon Investment Managers, thank you very much for your time, and hopefully we'll see you again next week.